All right, let's talk about leveling up your portfolio. If you feel like you've mastered the basics of investing with ETFs and mutual funds, and you're wondering what's next, well, you are in exactly the right place. Today, we're diving into a strategy called direct indexing. It's a powerful approach that could give you way more control and some pretty serious tax benefits. So let's get right into it. So if you're an investor, especially one who spends any time online, these tickers are probably like a second language to you, right? VOO, VTI, they're the bedrock of modern passive investing. It's how millions of us get exposure to the market. But here's a thought. What if you could own the market without actually owning a fund? And that, right there, is the huge idea we're going to unpack today. You see, instead of buying a share of a fund, which is basically just a pre-made basket holding hundreds of different stocks, what if you just owned all of those stocks yourself, directly in your own name? That, in a nutshell, is direct indexing. So here's our game plan. We'll start on familiar ground with standard index funds. Then we'll get into what direct indexing actually is and explore its biggest selling points, personalization and tax savings. We'll even put it head-to-head with other strategies, talk about the current challenges and its future, and then wrap it all up with the key takeaways so you can figure out if this makes sense for you. Okay, so let's start with what most of us know and do. For years, the goal for passive investors has been super simple and honestly pretty brilliant. Just match the market's performance for the lowest possible cost. And yeah, we typically do this with ETFs and mutual funds. You buy one share of VOO and boom, you own a tiny slice of the entire S&P 500. It's incredibly efficient, it's dirt cheap, and it's easy to move your shares from one broker to another. But it's a one-size-fits-all kind of deal. You get what you get. And as a lot of us have probably found out, some brokers still don't let you buy fractional shares of ETFs, which means you can end up with cash just sitting there, doing nothing. And this is exactly where direct indexing enters the conversation. It takes that same core idea of tracking an index, but then it adds this really powerful layer of direct ownership, and maybe most importantly, control. So let me spell out the key difference here. Instead of owning, say, one share of an S&P 500 ETF, a direct indexing strategy takes your money and actually goes out and buys you shares in hundreds of the individual companies inside the S&P 500. All those stocks, Apple, Microsoft, all of them are held in your name in what's called a separately managed account, or an SMA. You can just think of it as a personalized portfolio managed for you. Here's my favorite analogy for this. Think of an ETF as one of those pre-packaged meal kits. You get a box with everything in it, and you have to follow the recipe exactly. No substitutions. Direct indexing, on the other hand, is like getting all the fresh raw ingredients for that exact same meal delivered to your kitchen. You can still make the same dish, but now you have control. You can leave out the onions if you hate them, or maybe add a little extra spice. And this control leads us to the two giant advantages of direct indexing, the reasons this is getting so much attention right now. First, deep customization, and second, something called tax alpha. Because you own the stocks yourself, you can truly make the portfolio your own. You can screen out companies that don't match your values, say ones with high carbon emissions. Or imagine you work at a big tech company and already own a ton of its stock. You can tell the strategy, hey, let's limit my exposure to that sector a bit. It can even build around shares you already own, so you don't have to sell them and trigger a big tax bill. But for a lot of people, especially those with taxable investment accounts, the real superpower, the single biggest reason to even consider this, is the potential for tax alpha. So what on earth is tax alpha? Well, it's the extra return you can potentially squeeze out of your portfolio using a strategy called tax loss harvesting. Now, with an ETF, you can only sell the whole thing if the fund is down, but with direct indexing, you can be much more surgical. Imagine the S&P 500 is totally flat for the year. Inside that index, some stocks are up, some are down. You can sell just the stocks that are down to create a capital loss on your tax return. You then use that loss to offset gains you might have somewhere else. It's a way to potentially boost your after-tax return without really changing your market exposure. And the potential impact here is, well, it's staggering. Just look at this. This data comes from historical simulations run by Morgan Stanley. In the U.S. large-cap core space, we're talking big, stable American companies. A direct indexing strategy with tax loss harvesting delivered after-tax returns that beat the median active fund an incredible 98% of the time. That just shows you how incredibly valuable tax alpha can be, especially in markets where it's already really hard for active managers to get an edge. Okay, so that all sounds pretty great. But how does this strategy really stack up against the other options you have? Let's put them head to head. All right, let's break this down. Your standard index tracking ETF, it's got zero customization and very limited tax loss harvesting, but it wins on fees. It's the absolute lowest cost. Then you have an actively managed account, which gives you some of those benefits, but it's not as precise. Direct indexing really carves out this amazing middle ground. You get full customization, that super surgical single stock tax loss harvesting, all for a low expense ratio. Though, to be fair, it's usually a bit more than a rock bottom ETF. But, of course, it's not perfect. No strategy is. There are some really important drawbacks to know about. So let's get into the limitations and, maybe more excitingly, where all of this is going. For the longest time, the biggest hurdle has just been the massive price of admission. I mean, historically, direct indexing was a tool pretty much just for the super wealthy. And even today, the typical minimum to get started is still around $250,000. And beyond that high minimum, the fees are generally higher than a basic ETF, often around 0.30%. And because you now literally own hundreds of individual stocks, you can imagine your account statements and your tax prep get a whole lot more complicated. It's also not a magic wand. It can't completely eliminate the risk of having too much money in one stock, and it might not track the index quite as perfectly as an ETF. But here's the good news. The future looks much more accessible. This is why we're even talking about it now. The rise of fractional share trading is a total game changer. It lets platforms replicate an index with much, much less money, which is going to keep pushing those minimums down. And new tech, like unified managed account platforms, are making it so much easier for advisors to manage these strategies for more and more people. So let's pull all this together. How do you figure out if this is a strategy that's actually worth looking into for your own portfolio? Well, this flowchart from Morgan Stanley is a really helpful way to think about it. For what they call efficient markets, like U.S. large cap stocks, where it's notoriously tough to beat the index, passive strategies are often the smart play. And within that passive world, if you have a taxable account, direct indexing with that powerful tax loss harvesting can offer a really significant advantage over just holding a standard ETF. And really, it all comes down to this. If you're investing in a regular taxable brokerage account, you just can't afford to only look at your pre-tax returns. Taxes can take a huge bite out of your growth over time, so any strategy that actively tries to minimize that damage is worth a very, very serious look. Look, direct indexing is a huge step forward for passive investing. It's moving us away from a one-size-fits-all world into an era of mass customization. So the final question I'll leave you with is this. Is that level of control, that focus on tax efficiency, the future of your portfolio? This is not financial advice.